like to note that the board began with an executive session for legal matters. So we will first ask the board to approve our virtual procedures for today. A motion to adopt the new procedures has been made and seconded. Is there any discussion on this item? Hearing none. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
Approve.
Paul? Paul, you're on mute.
I approve.
Thank you. Carroll?
Approve.
And Callan?
Approve.
Motion carries unanimously. Item 2, motion to approve our minutes from the December 9th, 2021 meeting has been made and seconded. Any discussion on this item? Hearing none, we'll move to the roll. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Carroll?
Approve.
And Kellen?
Approve.
Motion carries unanimously. Item 3, motion to approve 316 pension applications and 136 withdrawal applications has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Vanessa?
Approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Carroll?
Approve.
And Callan?
Approve.
Motion carries unanimously. For 3B and for cases 4C and 4D, pursuant to 12-035, a motion has been made and seconded for the appointment of a new medical panel. For the following cases: Terry L. Covington, 3B, Andy Ray Conover, 4C, and Martin Thomas, 4D. Any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Deny.
Roosevelt?
I approve.
Paul?
I approve.
Carroll?
Approve.
And Kellen?
I approve.
The motion carries 7-1. 4A, a motion to approve the service-connected disability benefits for Travis Washington has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
Approve.
Paul?
Approved.
Carroll?
Approve.
And Kellen?
Approve.
Motion carries unanimously. 4B, an application to approve the service-connected disability benefits for Najee Scott Williams has been made and seconded. Is there any discussion on this item? Hearing none. Brian?
I approve.
Vanessa?
Approve.
Marcia?
Approve.
Sherilyn?
Deny.
Roosevelt?
I approve.
Paul?
I approve.
Carroll?
Approve.
And Kellen?
Approve.
Motion carries 7-1. 4E, an application to approve the service-connected disability benefits for Wendy Turlong has been made and seconded. Is there any discussion on this item? Hearing none. Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Sherilyn?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Carroll?
Approve.
And Kellen?
Approve.
5A, the application for survivorship benefits as a medically dependent adult child regarding Isabel Siegel, the deceased, on behalf of Mark Siegel, or for Mark Siegel, has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian,
I approve.
Vanessa,
I approve.
Marcia,
Approve.
Sherilyn,
Deny.
Roosevelt,
I approve.
Paul,
I approve.
Carroll,
Approve.
Ellen.
Approve.
Motion carries 7-1. 6A, the application to rescind drop enrollment for Richard Krosick has been made and seconded. Is there any discussion on this pending motion? Okay.
Jackie, I'd like to make a motion to send this to a hearing panel. I think there's some documents in there that need a little further review before we can vote on it. So I'd like to make that motion.
Thanks, Brian. Is there a second to Brian's motion?
Second.
The pending motion would be withdrawn, and then the motion to send to the hearing panel
Thank you, Jim. So
is
the
on the
pending,
table.
thank you. The pending motion's been withdrawn. There's been another motion to send this case to a hearing panel that was properly seconded. Any discussion on the new motion? Okay. Hearing none, we'll go to the roll. Brian,
I approve.
Vanessa,
Deny.
Marcia,
Deny.
Sherilyn,
Deny.
Roosevelt,
I approve.
Paul,
I approve.
Carroll,
Approve.
and Kellen.
Approve.
The revised motion carries 5-3. And that moves us into new business and the executive director's report.
So the 1099s have been printed. They were actually completed a little early this year, and they are also available. So everyone knows they're available in our imaging system. So if someone really wants it quickly, they can contact us, and we can always email it. So the 1099s are available. The annual audit, we received the final documents for review. Once we review those, which should be in the next couple of days, that will be wrapped up. Just a reminder, the February meeting will consist of the actuarial presentation, the annual actuarial presentation from Chiron, and the March meeting will consist of the experience study from Chiron. And we are lucky to have Chiron here today also for the PAF, which is a good thing. So that's all I had.
Thanks, Fran. Is there any other new business before the board? Okay, that moves us to the litigation summary.
There are a few cases in common pleas and oral argument coming up in one of them. That's all.
Thanks, Ellen. Any questions for Ellen? Okay. A motion to adjourn has been made and seconded, and hearing no objections, the motion carries unanimously, and we'll move ahead into our deferred compensation portion of the meeting. The first item is approval of our minutes. That has been made and seconded. Any discussion on this item? Hearing none, we'll go to the roll. Brian,
I approve.
Francois, or Sherilyn?
I approve.
I
Thank you.
approve. Oh, sorry.
Okay, thanks, Francois. Vanessa,
I approve.
Marcia,
Approve.
Roosevelt,
Approve.
Paul,
I approve.
Carroll. Come back, Kellen.
Approve.
Approve, I'm sorry.
That's okay. Thanks, Carol. The motion carries unanimously, and that brings us to the plan update.
Good morning, everyone. On the investment side, fourth quarter performance will be at next month's meeting. And so Nationwide can give the field update. Brad or Bina?
Good morning, everyone. Happy New Year. As of December 31st, deferred compensation plan, the ending balance was $1,791,274,099.19. That's about 2.2% increase since the month of November. Total participants with account balances, these are your active, inactive, as well as those that have retired but have retained their account balances. There's 24,498 participants. That is 40 less than the month of November. Actively deferral participants is 19,111. That's 29 less than the month of November. New enrollments, we received the highest new enrollments in third quarter in the month of December at 136. That's 70 more than the month of November. Inactive participants, we saw a decline. The total participant inactive count is 5,387. That's 11 less than the previous month. In the 401A plan, the ending balance as of December 31st is $2,064,310.53. That's about 2.3% increase from the month of November, with 877 participants. That's 4 less than the previous month. Call volumes did decrease in the month of November in comparison to previous months because of the holidays. We handled 2,812 calls. That's about 142 less than the previous month. One of the things that participants continue to leverage is setting up their online account. Right now, as of December, there's about 70.5% participants that are utilizing the resources on the website. Percentage option, as of December 31st, 1,015 participants are leveraging the percentage contribution. That's an increase of 20 more than the previous month. We are working on a campaign which will be sent to staff to raise the awareness of the percentage contributions. Roth 457 continues to trend and increase. There are 4,036 participants that are enrolled in the Roth. That's an increase of 84 more than the previous month. The total account balance in Roth is $20,177,130. That's about 9% increase in the previous month. As you can see by the age group, the age group that's leveraging the highest amount and enrolling in the deferred comp is the age group 30 to 39. They comprise about 35% of the total participant count. Any questions for me? If not, I'm happy to answer anything. If not, I will pass it on to Brad to discuss the December service activity report.
Okay, Bean, I have a question. So can you explain what makes a participant inactive and how long do we keep them on the books?
Inactive compromises of those that have stopped their contributions, or it could be those that are still employed but have stopped their contributions, or that have left employment but they're still counted. So as long as they have an account balance but they're not contributing, that's the account that you're seeing, 5,387.
So, and is there a fee assessed to them for being inactive?
Yes, as long as they have an account balance, there is a charge that they do have to pay.
Okay, thank you.
Thank you. Brad?
Perfect. Thank you, Bina. Good morning, everyone. So for the month of December, the local service team conducted 69 one-on-one consults. 23 of those were using the My Interactive Retirement Planner. The local team had 37 enrollments into the plan during the month of December. And there were 17 workshops that accounted for 394 attendees. Those were highlighted by our Social Security and Retiree Healthcare, which are conducted in partnership with the Nationwide Retirement Institute, who conduct great webinars to assist folks with those topics. I know that with the board, I know that staff had informed you that our PRC CFP Jason Salmon has left us and went on to a new challenge. So I wanted to just give everybody an update on we are actively recruiting to fill that position. That position reports to FRS, our business partner, minority-owned business partner. Thus far, we've had 21 candidates apply for the position. Unfortunately, only 2 of them held their CFP designation, so 19 of them were eliminated right off the top. But we are, I received a resume late yesterday afternoon, so I'm going to be meeting with that person. Just wanted to give everybody an update.
And Jack, just briefly, without going into specifics as to what Jim and I were in a meeting yesterday with a large agency, and the reason they requested the meeting was that they're looking to do an RFP for their deferred comp, and they were asking about our deferred comp. This board and then working with Nationwide, but this board deserves a lot of credit for the construction of this deferred comp plan, because I can tell you, compared to other agencies, compared to the agency Jim and I talked to yesterday, I'm going to just go down a list of things: fees, the Roth 457 availability, the percentage of investment availability, the education and participation percentage, the free financial advice from the CFP, the number of staff available, to answer questions and respond. It's almost unprecedented in among different agencies, specifically this other agency. So, just the fees alone is an amazing difference. You have an agency that's paying 80 basis points, 0.80% just to the provider, not to mention the fees that they're paying for the underlying investment vehicles, the mutual funds. So, it's really, the board should be very proud of the plan that they have put together. And I know I can remember all the subcommittee meetings where Carroll was pushing for education. Get out there. When I told the person from this agency that our folks from Nationwide, pre-COVID and even now online, but go out to the airport for the 3 a.m. shift, or go out to the various police districts for the various shifts. They could not believe that. Their providers just set up the plan and that's the end of it. So the board has done a really good proactive job with this plan for the members. And I shouldn't just say the board also. Dominique, who heads this for the staff and Nationwide, it's really a good collaborative effort. So, a lot of the aspects we have, other plans don't have. So, I know you don't hear that all the time. So every once in a while, it's good to get a little compliment. So you guys have done a really good job on that. So congratulations.
I ditto that, Fran. Thank the staff and Nationwide for the job well done, and for the educational program we have set in place. It really, really has impacted and helped the members understand. And I want to thank them, especially Brad, who was on early on and heard us talk about, when you talk to the members, start low and then go high, because you scared them away. And so I can actually attest to Nationwide encouraging employees to start with $25 if that's the case. So our educational program is like the best too. So thank y'all so much.
Thanks, Carol. Thanks, Fran. Any other questions for Nation? Okay, I think that's a good transition to our third item.
Looks like, I think that was, no, I think that was a mistake. They called on me, except Diana's there.
Hey,
and
Francois.
Jackie,
Hey, Francois, can you put yourself on mute? And I do see that Diana's here now, so I'll make sure I include her in the roll call. All right, that brings us to item. That's okay. Brings us to item 3, the discussion of the Roth 457B conversion option. is this Fran or is Nationwide handling this item?
I'll jump in. We were asked, staff and Nationwide were asked at the last meeting about the availability of in-plan Roth conversions, excuse me. Nationwide has prepared the attached, I believe it's 3-page FAQ. And I think the law department is prepared to make brief comments about what would be required from an either adoption agreement and or plan document amendment process should the board today or at a later date decide that this is something they'd like to offer the participants. So Brad, I don't know if you were going to go through this or Bina in terms of the FAQs, but floor is yours, or certainly trustees, can jump in with questions.
Sure. Thank you, Chris. We'd be happy to provide key bullet points of the in-plan Roth conversion. One, who is eligible, Nationwide can record keep and do the in-plan Roth conversion. Participants, their spouses, beneficiaries, or spousal alternative payees are able and eligible to convert any portion of their pre-tax assets within the plan and roll it and convert it to Roth, which is after tax, without having to take a distribution from the plan. Now, a few things to keep in mind is participants are responsible for the dollar amount that they convert. They're going to have to pay ordinary income tax for the amount that they've converted, and they will receive a 1099-R from Nationwide. It is the responsibility of the participants to work with their tax advisor to understand the tax implications. Now, once the in-plan Roth conversion has been processed, it is irrevocable. So therefore, that's another thing that participants do need to keep in mind. There are advantages that if one wants to convert during early years, there is advantages to, moving the dollars from pre-tax to after tax. However, the disadvantage are the fact that there is a tax consequence and implications that they have to factor in. We do have, our subject matter experts, if there's any questions regarding the processing or participant questions that you'd like for us to answer.
Thanks, Bina. Any questions from the board? Okay. And Chris, my understanding is that if the board wishes for this to be an option for its members, that we would need to take a vote to amend the plan documents. Is that correct?
Defer to the solicitor, to Ellen on that. I think there's a little bit of discussion about whether it would be a plan document amendment, a separate adoption agreement, or both. But yeah, there would have to be some sort of contractual, or legal documents, executed with the law department's assistance.
I don't think it's complicated. The only thing that we would want to be certain about, in addition to the amendment, is that Nationwide would issue a notice to people advising them that there would be tax consequences, essentially reiterating what Bina just said. That's all.
Okay. Thanks, Ellen. Are there any?
So is Ellen saying we don't have to amend the plan document?
No, we would, I believe we would be amending the adoption agreement. But it's not complicated once the board decides this is what it would like to have happen.
Ready?
Okay. All right.
Thoughts from the board on this?
I'd just like to, and I think Ellen sort of touched on it, the key here is that people understand. We'll definitely have folks that will capitalize on this if we make it available, and then come back when they get their tax bill and say, I didn't understand, it wasn't explained to me. We see this a lot with people trying to change survivor options with pension, right? I think it's pretty similar to that. Once they realize the financial impact of an option 2, they may not care for that. So we have to have a clear document signed so we can fight these fights to say, hey, you had every opportunity. This was explained to me. I fully understand all the good stuff, because we will absolutely have folks coming back once tax time comes. So I like the option. I like it, but I understand it, right? That's the key. A lot of our members will not understand what we're talking about right now. So we have to get them to sign to say that they do understand.
And Brian, to that point, there would be a paper form that a participant would have to sign to do this, and we do have some leeway on some language on that form, so we can work with staff to make sure that that form is very clear and very concise as to what the participant is signing up for. And so we will still have people that will come back, but that's.
Any other questions, or does the board wish to take any action on this today?
I'll make a motion, Jackie, that we include the in-plan Roth conversion product into DC plan.
Thanks, Carol. Is there a second?
I'll second that.
Okay. Motion has been made and seconded to include this as an option for our members. Is there any discussion on this item? Hearing none, we'll go to the roll. Diana?
Approved.
Brian?
I approve.
Vanessa?
I approve.
Marcia?
Approve.
Roosevelt?
I approve.
Paul?
I approve.
Carol?
Approve.
And Kellen?
Approve.
Motion carries unanimously. A motion to adjourn our deferred comp portion of the meeting has been made and seconded. Any discussion on this item? Hearing none, we'll move into the investment committee. And Rob may be unable to make it today, so I'm gonna get us started. The first item is approval of our December minutes. Motion has been made and seconded to approve the minutes. Any discussion on this item? Hearing none, we'll go to the roll. Diana?
Approve.
Brian?
I approve.
Vanessa?
Approved.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
Approved.
Carol?
Approve.
And Kellen?
Approve.
Okay, motion carries unanimously. That moves us into discussion on the pension adjustment fund. We'll turn it over to Chiron.
Good morning, everyone.
Good morning as well. Brett Warren from Carroll.
Good morning.
Can everybody see my screen now?
Yes.
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 So we're here today to discuss the pension adjustment fund. We're going to review the amount in the fund, the transfer that will be happening for July 1, 2021 valuation. We'll review the calculation of the market value of assets that's used to calculate this transfer amount. And then finally, we'll review options for distributions. Just as a refresher, the last time a transfer happened was about, there's been no money going into the PF for about 5 years now. And the board, the last distribution that happened was in 2017 for amounts that were in the fund as of July 1, 2016. So the PAF increased from 1.24 million as of July 1, 2020 to 76.47 million for July 1, 2021 because of a transfer going in for the 7/1/21 valuation. The calculation of the PAF and the amounts that go into the PAF are clearly defined in the Philadelphia Code under Title 22. The first part of this calculation is calculating what's called an adjusted market value of asset. That's a smoothed asset value based on a 5-year smoothing method. Any excess returns based on this smoothed asset values and a year return would be transferred into the PAF. The return on the market value, so the cash in the bank, the fair asset value for June 30, 2021 was 28.42%. Part of this was that there was a lot of volatility in 2020 with the pandemic, and June 30, 2020, assets were at a low. The market then recovered and did really well. So June 30, 2021, and we ended up with a 28.42% return. Based on a 5-year smooth asset value, that return was 10.75%. And so half of the excess earnings above 8.5%, which is determined based on the prior investment return assumption, which was 7.5 plus 100 basis points. So the difference between 10.75 and 8.5, 50% of that goes into PAF, which resulted in a 74.87 million transfer into PAF. So here we're showing the calculation of this adjusted 5-year smooth asset value. The PAF at the beginning of the market value of assets at July 1, 2021, this is showing in thousands, so this is actually $7.4 billion. We subtract what's currently in the PAF, which is 1.597 million, and so we start the net PAF, the net market value being 7.423 billion. For the 5-year smoothing, each of the year's investment gains or losses are spread over 5 years. So most recently for the year ending June 30, 2021, I just mentioned that that was a 28.42% return, which resulted in a $1.218 billion gain. 20% of that is recognized for this year, and the remainder is deferred. So for each of the years, the deferred amounts are added up, which results in a total deferral of 753 million. We deduct the deferral amounts from the market value of 7.42 billion, resulting in an adjusted market value for July 1, 2021 of 6.67 billion. As of July 1, 2020, that was 6 billion. It increased to 6.7, and so the calculated return on assets for that year was 10.75%. So here we're showing the reconciliation of the pension adjustment fund for both years, for June 30, 2020 and June 30, 2021. So just focusing here for the most recent year, we started the PAF at the beginning of the year at 1.24 million. The return on assets was 28.42. So that beginning of year is increased based on the asset return, resulting in a year value of 1.597 million. This is before any transfer amounts. We just calculated the smooth market value at 6.67 billion. And based on that 6.67 billion, we had the adjusted market value asset return at 10.75. The difference between this and 8.5 is 2.25%. So this results in a transfer of 74.87 million going into the PAF, resulting in an end of year number of 76.47 million. So typically, when there is a transfer into the PAF, the board will review and determine the amount to be distributed. Our understanding is these distributions need to be made by the end of March of this year. We do have a live calculator we'll be reviewing. Typically, the participant groups that are considered are in-payment retirees, disabled retirees, and surviving spouses and other beneficiaries. We will review all the different alternatives that we've set up. The board could choose to do a one-time lump sum payment. This could be based on a multiplier for the years of credited service and or the years in retirement. It could be a one-time 13th check, which would just mean that members would get an extra check in the same amount they typically would receive monthly, or a flat dollar amount, $1,000 or whatever it is that's the board may decide for every retiree and beneficiary payment. Or another option to consider would be ad hoc cost of living adjustment. This would be a percentage of the current monthly benefit. So we'll go to the calculator to review all the different options, and we can also review what was done the last time a distribution was made. Just before I switch, just a note to let you know that should the market or the investment return for fiscal year ending 2022 end up at least 7.5%, which is our assumptions. If this assumption is met, we are anticipating more PF transfers into the, going at least in the next year. So with that, I'm going to switch to our live calculator. Do you see the pension for PAF calculator?
Yes.
Yeah,
Yes.
this looks good.
I wasn't sure how that would work. Okay, so just to review what we're showing here, all of the yellow cells can be changed. So we're working with a 7/1/2021 date. We've just determined that the PAF value at July 1, 2021 is 76.47 million. The board can decide how much of this one they would like to distribute this year. So if we could change this to 100% or 50%, which was what was done the last time a distribution was made. The eligibility cutoff date, typically when the board has done this before, they've considered members who've been in payment for at least 10 years. So that this is based on that, going back 10 years to June 30, 2011 as the cutoff date. We can apply a minimum service credit for anybody that did retire under service-connected disability. We have 20 years in here based on what was done previously. In the white cells here, we're showing a summary of the data. This is based on our estimated data based on what we receive for valuation. Once the board determines the type of distribution we need to make, we will be collecting from the city the actual data for the payments for these retirees. But for this purpose, this estimate is should be pretty good. So we're looking at about 13,712 retirees. 2,803 disabled members and 6,888 beneficiaries. And this is based on this eligibility cutoff date of June 30, 2011. Reviewing the options I just mentioned, one option could be that we could decide, the board could say how much of this, their target amount they would like to credit towards the service multiplier. When I say service multiplier, that would be a multiplier times the credited years of service. So if it's 35.72 and a member has 10 years of service, then the member would get $357 for the 10 years of service. Retirement is based on the number of years of retirement and works similarly. The second option would be to treat the service multiplier and retirement multiplier as the same. This number is backed into based on the amount that's in the PAF and 50% of that being distributed for the year. We have the option of the ability to review different service and retirement multipliers for each of the groups, should the board like to see that. Option 4 is the 13th check. 100% in this cell means each member gets one extra check in the full amount that they typically would. And this is a cost of living adjustment. It would be a one-time increase. If the benefits are increased 1%, then for the rest of their life, their benefit would go up by that 1%. So just looking at an example here, if a member had 30 years of service, 5 years in retirement, and $2,000 for their current monthly benefit, these amounts would show how much they would receive under the PF distribution.
Anu, just to be clear, that person wouldn't receive anything under the current structure because they've only been retired for 5 years, right?
Yes, so I believe this is determined based on right, you're right. So there should be at least 15 then.
So it could be one thing to note from what was done last time, if it's a survivor who had a participant who was in payment for more than 10 years.
Yes.
And then a survivor who just started within the last 5 years, then in that situation, somebody could have 5 years in a survivor status.
That's right.
If it's helpful, I do have a list of all of the considerations from the last time PF distributions were made. This is not in your booklet, but I thought it would be helpful just to kind of review what was done before. So the last time the board considered this, the distributions were spread over 2 years. So the first year when the PF transfer happened, half the amount was distributed with the 50% of it distributed in the following year. Eligibility, members were eligible if they had been in payment for 10 years. The fixed multiplier was applied in equal amounts to credited service years and years in retirement. If the member was a service-connected disability, then they got a minimum of 20 years. Of course, if they had more than 20 years, they got the higher amount. For beneficiaries and survivors, if the beneficiary was resulting from an active member's death, then the eligibility was measured from the date of death of the participant. If the death was based on a retiree in payment, then the cutoff of eligibility was based on the participant's date of retirement, though the amount that the survivor got was based on, their own commencement benefit, their own commencement date. And members who were in drop, their drop years were included as service years, so they got credit for the years in drop, but that wasn't used towards determining eligibility. So based on all of those, if the same methodology was applied, so 50% distribution for this year gives us a target amount of 38.23 million. Option 2 was what was picked last time. The multiplier would be approximately, $38 for each year of credited service, each year of retirement service.
So Anu, this is based on if we leave the same amount of money in the fund, like if we leave $1 million in the fund?
This is based on leaving at least half in the fund. So if you want to use up the entire fund, then because the fund is 76.47, you want to use up all of it, distribute all of it, then the multiplier could be as high as $76 or 75.99.
I think what Carroll was referring to, Anu, was do we keep any cushion in there? For example, it's $76.4 million. Do you keep a cushion of $471,000 in there, for example, and just distribute the 76 million over 2 years, just in case of adjustments?
Yes. So, and we could do that. So if we did that, the multiplier would be 75.52. And so the board could decide 76 million, and we could collect the actual data and back into what the multiplier should be.
I have another question too. So for service-connected disability, so what qualifies them to be included? Like, do they have to have 10 years of service, or do they get it just because they have a service-connected disability?
Right, they get it just because they have a service-connected disability.
So they could be or service-connected disability, let's say as of May of last year, and they still get it? Like, I'm asking the question, so if they're not vested and they get a service-connected disability, we're going to give them 20 years of credit service?
So the question is whether they would need to be in payment for 10 years to be eligible.
Yes.
I would have to check how we did that last time.
Well, I guess my question is more to the board than to you, Anu, so that's something we
Right.
have to talk about. All right. Go ahead. Oh, I mean, go ahead.
Yeah, and it could be whatever the board decides they would like that to be.
Yeah, so Carol, it was anyone that was in service-connected disability, not 10 years ago or is at the time, and that's what the board decided. However, pursuant to 22-311, the board determines the criteria for distribution. So if the board determines that someone needs to have X amount of years of credit of service, even if they are a recipient of service-connected disability, that's up to the board. It could be, I mean, that's the board's determination to make.
Yeah, but
Fran,
maybe
just to be clear, someone who got a service-connected disability 3 years ago would be eligible for this check today?
I don't believe that the 10 years applies to that. But we can go back, I'll go back and check the records.
I'd like to know, because in my opinion, I think they should, I don't know why we treat them any different. I mean, we gave them the same pension, maybe a better pension than everyone else. And if they've only been out 3 years, the point of this is to sort of offset inflation, right? A cost of living adjustment of sorts. I don't know why we would treat them any different. I hope we're not.
The 10 years is a baseline. So the 10 years is a baseline regardless of what type of benefit you're getting.
So you have to be out 10 years no matter what to be eligible for this benefit.
That's right.
Okay, yeah. I think that's a good idea.
So, but then why would we give them 20 years of credit service?
That was the board's call in the past. That's the board's call. I assume because they got injured through no fault of their own and they were no longer able to accumulate credit service, but that's just speculation. I can't say exactly.
Okay, so back to what Brian is saying, that they're already getting a better pension than the regular retirees are getting. Their pension is tax-free at a higher rate. So I just would like for the guidelines to be applied across the board. So even if they are service-connected disability, they have to be 10 years before they are considered. And for the PFA, and if you, I don't know about applying 20 years of service-connected disability. I understand what you're saying. But maybe we can reduce that to 10, I think. I just think giving them 20 years of somebody walking out the door and only been in the city 3 years and they get injured on the job, respectfully, I have respect for that. They whatever, but we also have retirees out here that's only getting like $200 a month, and they've been getting $200 a month for the last whatever years in JKL plan. So respectfully, I would just like to see that reduced to maybe if we're going to credit them any service, just given that they didn't do that, they didn't have time to work that long. I would rather keep it to the 10 years. We're going to give them 10 years or credit them 10 years and not 20. I hope I'm not confusing people, but
no, that's totally up to the board. So that list of criteria that Anu showed on the other slide, which was you have to be retired for 10 years. That's a baseline for everyone, right? So you have to be retired for 10 years. The slide here with the service-connected disability benefit, bullet point 4, service-connected disability benefit gets a minimum of 20 years of service credit. That was what the board determined. So the code does not provide guidelines. The code says that it's up to the board to determine how the PAF money will be distributed. So the board can say whatever they want. I mean, the board could say service-connected disability benefits gets a minimum of 25 years of service credit. Could say service-connected disability people get however many years of actual credited service that they have. I mean, it's up to the board to make that determination. So this is just what's been used the past several times that the PAF has been distributed. But that's certainly within the board's discretion to make those determinations.
Fran, correct me if I'm wrong, and I'm asking, I don't have the code in front of me. If we have an ordinary death, at least my folks, if ordinary death, they have 4 years on the job, we move their survivor pension up to a 10-year benefit. Is that right?
Well, that's per the code, yes.
So it's, I think 10 years is the right number. That's all.
So I think so. These are the criteria that were used last time. If the board wants to consider altering these, that's fine. That's within the board's discretion. It would just, we'd have to make sure what the criteria are. Somebody make a motion, and then have a vote. That's how this would be decided. Once the criteria are set, the information would be gathered by the actuary. The information provided to us, and then the payroll will be processed and payable in April or May. That's normally when it's paid each year. So that's the general process. So that's what we have. And then the board, another determination is bullet point 1. The distribution last time was spread over 2 years, and half of during 1 year, half paid the other year. The benefit of that is that someone this year who maybe has been retired for 9 years misses out because they hadn't been retired 10 years. They would be included in the following year. I mean, there's always going to be that 9th year person, no matter how many years you spread it out. However, that's been part of the thinking as to why the board has divided up in 2 years. Plus, they thought it was nicer for the members to get a payment, for as many years as possible, this case being 2 years. So, yeah, that's, I mean, if you wanted to look at footnote 2, you could look at that also. I'm not suggesting that, but is the eligibility 10 years? Is it 5 years? Is it 15 years? That's up for the board to decide. So all of these things are aspects that the board can tweak, can change, can eliminate, or do whatever it feels is best. So I don't know if there's some things on here you want to keep the same and maybe tweak the service connected disability part or whatever you want to do, but that should be decided today in order for the timeliness of the actuary to do their work and payroll to do their work, so this could be payable in April or May.
Okay, so then the other thing is, what if we increase the amount of money that we're distributing and decrease the amount of money that we're leaving on the table? So what if we take it? You said it was 470 what, Fran?
I just rounded it. It's 76,471.
No, you said 471.
Yeah. So if you just round this number here to 76 million, that way you leave 471,000 in reserve. That's all I was saying, just because it's a round number. Yeah.
If we did that, changed the service connected to 10 years and fixed the amount to be distributed at 76 million, members would get about $76.36 for each year of service credit and each year of retirement.
Is that over 2 years anew or 1 year?
This would be this 1 year.
Can you do it over 2 years?
Go ahead.
Maybe put like 49% or something, or buffer.
So this would be 37.5 million this year, 37, with the expectation we would redo all of these calculations because the years would change, right, the following year. But in year 1, where 37.5 million would be distributed, about $37.65.
So does everyone see this multiplier here, which is $35.74 down in the middle, towards the middle of the screen? So last time we did this in 2016-17, the multiplier was $32.75. So it's kind of right in the ballpark with where we did it last time as far as the multiplier is concerned.
Right. And we're actually looking at option 2 here. So it's actually $37.65.
Right.
Though we'd actually, when we have the actual data, it might be plus or minus $1.
Yeah, so
Um,
to be clear, the new this scenario that you're showing here has all of the same factors except for 10 years of credited service for those who have been retired 10 years and out on service connected disability.
we actually changed that. That was something we could change here.
It's
So
10
it
years,
is
right?
based on 10 years, yes.
Yeah.
Can you
So
see
this is I'll call this the Brian Carroll scenario, just for now. Sorry about that. So yeah, this is with everything the same, paid over 2 years. Anu, could you change this to a flat 76 million?
over 2 years, right?
Yes.
That would just be
Instead of 76, 471, 047.
yeah. Okay. So that's actually about $38.18.
And that's over 2 years.
Yes, so this would be in the first year. We would have to redo this calculation in the second year because, 9-year people might make it in, the membership will change. But it should be in the ballpark for the second year. It would be about $38 this year, again, with the $38 again the following year. And as I mentioned, if we hit the 7.5% return for this year, we are anticipating more PF transfers next year.
Yeah, no, that's a good point you make, Anu, that everyone should be aware of. I mean, from this year to next year, we don't know. I mean, there could be some unusual surge in the number of people who retired that are coming close to 10 years. There could be a decrease in the number of people who are now eligible who pass away and are not eligible the following year. I mean, there's multiple variables that we don't know what the exact number will be for the second year. So that's a good point that you bring up, Anu.
Yep, and we would look at actual data again next year, and based on, this 38 million number back into how much that multiplier should be based on, revised data.
Okay, so right now, and I'm just kind of keeping tab of this. So right now, we have all the same criteria we used last time, except for the service connected disability folks will get 10 years of credited service versus 20.
Correct.
Okay, so that's what's on the table right now for the board to consider.
Okay, so I guess Anu, can you change that? So this is based on 76, 471, 047, right?
No, this is based on, as Fran mentioned, if it's 76 million, keeping a 471,000 buffer, but spreading it over 2 years. So 38 million first year, 38 million next year. So it's really based on the 38 million for the current year. The current multiplier would be $38.18 per credited year of service and per retirement year of service.
Okay, and that's versus
service connected. Sorry.
And that's versus the last time. Yeah, the last time we did it, remember, it was $32.75. So the multiplier, I mean, it's not the same amount of money, but the multiplier is higher.
Right.
Which is good for the folks who have been retired longer, because they're the ones who are, the real, everyone's a beneficiary of this, but the real beneficiaries are those folks who have been in retirement for a longer period of time with no COLA or anything like that. And this is a nice adjustment for them. So, the higher the multiplier, the better for them.
So why can't we do more this year and do less next year? Why can't we make it 40 million this year and then do the lesser next year?
You could do whatever you want. You could do 76 million this year and 0 next year. You could do 2/3 and 1/3. You could do whatever you want.
Right.
No, I'm for doing 2 checks, but I just want to know why can we do the higher number this year and the lower number next year?
We could do that. So if you want to see, how much do you want to see, Carol? You want to see 45
40.
million? Sorry?
40.
40.
Would you say how much I want to see?
Yes. So 40 million.
How much
So
you want,
40 million.
given the constraints of how much we have?
Right. Given how much we have. But
Is that you, Rob?
I'm here, yes.
All right, there we go. Okay.
so 40 million would result in about $40.19.
And if we break it over 2 years, then that'd be 38.15 and 42.45. Right.
No, that's a different calculation.
Okay.
If we break it 2 years, likely next year would be,
Less.
lower. Yes.
Yes. But this year, what would the multiplier be? 38 or 40?
40. So this
Okay.
is what we want to look at.
Looking at option 2, right? I know.
Right. Option 2.
Okay. That looks good to me.
Anybody else have any thoughts, or are we ready for a vote?
I'd like to vote.
Okay, so can someone make a motion?
I'll make the motion, Rob, to adopt the plan as presented by Anu. So however we want to word this plan right here, I like the way these numbers are right here. So I'll make the motion to adopt this plan.
Is there a second?
Second.
Oh,
Okay. Actually, Jackie, can you do the roll? I don't have that in front of me.
Sure, no problem. So a motion
Jack-
to adopt.
Jackie, I'm sorry. Can we just clarify that the motion is to pay out 40 million in year 1 and 36 million in year 2?
There you go.
Yep. So distribution over 2 years, 40 million in the first year, approximately 36 in year 2. The service connected disabilities was adjusted to 10 years from the prior criteria, and retirement for 10 years, Fran, and no other changes to the previous criteria.
Correct.
Okay. Motion to adopt the stated criteria has been made and seconded. Any discussion on this item?
What do you think, Jackie? Do we want to clarify, when you say retired for 10 years, do we want to put retired effective at a certain date?
Yes, that'll be in the actuarial letter. So it'll be June, retired
30th.
through June 30th, 2011, right? Neil?
11.
Yeah.
Right. Yes.
Yeah, I think we should clarify that so we don't have any headaches. That's all.
Thanks, Brian. We'll reflect the June 30th, 2011 date. Any other discussion on this item? All right, hearing none, we'll go to the roll. Diana?
Approve.
Brian?
I approve.
Vanessa?
Approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
I approve.
Carroll?
approve.
And Kellen?
Approve.
Motion carries unanimously.
Great. Okay, so we move on to the,
Wait a minute,
Sorry.
Rob, so,
Yeah.
wait a minute, where we go? So Fran, you said, Anu said it has to be distributed by the end of March, or you saying in April or May?
No, her work is done by the end of March because that's
Okay.
when we
Right.
have the state filings and everything. But it's
Okay.
distributed April and May of each year. Yeah, that's when it's normally distributed.
Right, so our next steps will be to collect the data and we will send a final letter with all of the eligibility requirements, a summary of exactly how many people are eligible based on that and how much the multiplier is for the distribution to be 40 million for this year.
So
And that
last,
will be we expect to complete that by March.
so last time, Carol, in 2017, we received a letter on March 21st, 2017. So we normally receive that at the end of March. And then that's what we work off of in order to process the payroll.
So last time, Fran, did we include the PFA in the regular pension check, or did we just do two checks?
Separate check.
Okay, all right.
okay, we good?
Thank you, everyone. We'll be back next month with the valuation results.
Thank you, Anu, can't wait. Thank you all. That takes us to agenda item 3, which is the election of a board vice chair. Jim, do you want to walk us through the criteria and rules for the board?
Yes, thank you, Rob. So let me, as a reminder and refresher, read the applicable governing rules from the rules of the board. Article 1, Administration, Section 2, Officers says the following. The officers of the board shall consist of a chairperson and a vice chairperson. The vice chairperson shall be elected from the membership of the board by the concurrence of at least 5 members of the board at its regular meeting in January. And as an aside, this is the regular meeting in January of each year for a term of 1 year commencing on the succeeding February 1st. The designation of vice chair may not be removed until the expiration of the person's 1-year term, except for malfeasance or breach of duty and by a majority vote of the board. Also applicable is Article 1, Section 4 of the rules of the board, titled Vice Chairperson. The vice chairperson shall act as chairperson in the absence or inability of the chairperson or the chairperson's duly authorized designee alternate. So those are the governing rules as set forth in the rules of the board. At this point for the process, we would follow a process that's been adapted from the Robert's Rules for nominations and elections of officers. And that will involve just basically that the chair will call for nominations from the members. A member then can nominate a member to serve as vice chair. No second is required under Robert's Rules. If a member nominates a particular member, the chair will then restate it and say, such and such a member, such and such has been nominated to serve as vice chair. The chair will then ask for any other nominations. If there are none, the chair will declare that the nominations are closed. If there is another nomination, of course, then that nomination would be added. And when the nominations are declared closed by the chair, the chair will state the motion as to the effect that there's a motion to elect as vice chair if there was only one nominee, the following person. If there were more nominees, then it would be a motion to elect as vice chair from the following nominees, and then those nominees would be announced. At that point, the chair will ask for any discussion about that motion. Hearing none, the chair will then move to a roll call vote. The board will then vote for the vice chair. Remember that, as we stated in the rules of the board, at least 5 members of the board must vote for a nominee for that person to be elected as vice chair. And that's the process, and those are the rules.
Great, thanks, Jim. And when I get it wrong, please correct me as we go through.
All right, thanks.
Okay. So at this point, I'd like to call for any nominations for vice chair of the board. Are there any nominations?
This is Brian, Rob. Based on her years of service and her just absolute passion for the members, I'd like to nominate Carroll Stoops-Baylor.
Thank you. Thank you, Brian. That's great. Are there any other nominations? Okay, so the nominations are closed. So Carroll Stoops-Baylor has been nominated to be the vice chair of the board. So that's been moved and properly seconded. Am I doing okay, Jim?
That's fine, yes.
Okay, so now we'll call the roll. And for some reason, I don't have, I'm going to hope I get everyone. Unless Jackie, will you just call the names? Because I'll
Sure.
miss someone.
Diana?
Thanks.
Approve.
Thanks, Diana. Brian?
I approve.
Vanessa?
I approve.
Marcia?
I approve.
Roosevelt?
I approve.
Carol? Oh, I'm sorry, Paul. I don't know how to order. We'll go to Paul first.
I approve.
Thank you. Carol?
I don't know if I can vote, but I'll approve.
Sounded like Carol was undecided.
No, I don't know if I'm
Carol,
supposed to vote. Jim, am I
Carol,
supposed to vote?
you can vote or you can recuse yourself. That's fine.
I'm going to recuse myself. I just think that's proper.
We'll note the abstention. And Kellen?
I approve enthusiastically.
Great. So the motion carries unanimously. That's great. I'm very excited. Congratulations, Carol. It's a great moment.
And let
Do you
me
wanna
just say, I
say-
just want to thank each and every one of y'all. I mean, from the bottom of my heart, this is really means a lot to me that I have your support, and I thank you and hope I wear the hat well. Thank you so much.
I'm sure you will. Thank you.
You're
Thanks
welcome.
for being willing to do it. Okay. That takes us to agenda item 4, which is the MWDBE and local brokerage report.
Thanks, Rob. Just a quick comment or two, and then Kristen, who spends a lot of time each quarter putting these reports together, will quickly review the numbers. We will have the fourth quarter and year-end numbers at the February meeting. And I think you'll see we have preliminary data. We're still going through it for the fourth quarter. I think you'll see, as you did last year, that for a lot of the managers, the quarters start to even out. So when a manager has a down quarter, perhaps 2, over the course of 4, 6, 8 quarters, it starts to even out, and most of the managers wind up doing a pretty good job. That being said, Kristen will run through this short report for staff.
Kristen, if you're talking, you're muted. Unless I'm frozen.
Those are good numbers.
All right, I'm going to assume that her computer froze. Let me just, okay, so for the third quarter, overall really positive numbers for the equity managers. 44% of the trades in the quarter were directed to qualifying brokers, 47% year to date. Only significant outlier who, based on preliminary numbers, did have a much better fourth quarter in terms of the aspirational target was Investors Group. Most of the other managers, I think at worst, are in the high 20s, or I think there's one at 37%. So by and large, really strong use of diverse female and local brokers on the equity side. We break down the brokers that were used on page.
Chris, before we go on, can you just talk about Investors Group and what was going on there?
Sure. I mean, I think if you look, Rob, just in a raw dollar amount, they didn't do a lot of trades, period, in the quarter. There's only about $378 worth of trades. I think, as I was saying, in terms of how it tends to, even out, last quarter, the second quarter report, just as an example, when they did around $3,500 worth of trades, they were, in the high 20s. They were at 28%. So I would consider this particular quarter to be an outlier, from what we normally see from them. And again, the preliminary, unaudited fourth quarter numbers, look stronger.
Okay.
than this particular report for Q3. Turning to the fixed income brokers, or the fixed income managers, excuse me. I'll skip over Rumline for just a second. Generally good performance, a little bit, lower as an overall number, but still, relatively strong on an absolute basis. Garcia, Sim, and Longfellow all ahead of the target on a year-to-date basis. Lord Abbott, 26%. MetLife's numbers continue to trend upward. Rumline had no trading activity for the month period. So this wasn't a case of, again, a very kind of odd, an odd quarter, an odd quarter for them. If you go back and look historically, and I'm just pulling up the Q4 2020 report now, a year ago, their trades with qualifying brokers for the entire calendar year were at 66%. So again, this is a kind of an odd quarter where there was no trading of any kind. We will, as we always do when we do our quarterly calls, review not only the investment performance but the brokerage numbers with the managers. If we have concerns pending those calls, which have already started, we'll bring those to the trustees' attention at the February meeting.
Thank you. Any other questions for Chris? Okay, let's move on to the investment performance update.
Sure. Thanks again, Rob. I'll spend just a minute on the December and calendar year numbers, just because of the recent market volatility through 3.5 weeks of this month. December ended on a strong note for the board, 50 basis point outperformance at 3.2%, 14.9% for the calendar year, and just below the policy benchmark for the fiscal year at 3.8%. No actionable concerns with any of the managers. Almost all asset classes matched or outperformed their respective benchmarks. You will note updated performance information for the closed-end real estate funds, Clarion and UBS. UBS, while still trailing the benchmark, has continued to move upwards in terms of performance. I would also note the pace of their redemption queue has sped up significantly. We received in excess of $30 million from them a week or so ago. So there are, they are working through that queue and returning money to investors in a more prompt fashion. Looking at what's gone on the first couple weeks of January, and you did get estimates, I believe yesterday. The fund was down about 4.5% estimated so far in January, a little behind the benchmark on a fiscal year-to-date basis, now down about 1%, which is significantly ahead of the benchmark, about 80 basis points. That month-to-date underperformance being driven primarily by an overweight to equities, which again would also explain the outperformance in a lot of ways in December. Marquette will make some comments. I do think, and I heard from a couple of others,
Chris, one thing, that overweight in equities is really because of how well equities have performed, right? Not
primarily, yes.
Particular investment decision. It's just what's
Correct.
gone on in markets.
No, and we'll also in March have a good opportunity when the RRP payment or the bulk of the RRP payment comes in to revisit and rebalance, appropriately when we get those additional assets. Marquette's, executive summary, I think, as it always does, but particularly this month, did a really good job, and I heard that from a couple of others talking about how 2021 went and things that we're looking at in 22. They'll probably make a couple of comments. But look, we've seen a lot of volatility since the start of the year, even just today. Last night, when I went to bed, I think futures were down 400 points perhaps on the Dow. They were flat or not looking great this morning. The market's been as high as close to 600 this morning. It's up around 400 now. You have a lot of issues going on. You have the end of the coming end of the Fed's bond buying program and their, real clear intention based on yesterday's press conference to raise interest rates, which will obviously cause some folks, as they've already started to move out of, riskier assets. Inflation is a significant concern. It's running as high as it has in about 30 plus years. Interestingly, though, some sectors are still showing strong consumer spending in spite of this inflation. The real question for the economy is, will that, continue? Will consumers continue to spend if prices continue to rise? There's obviously COVID-related issues, not just the illnesses and the hospitalizations. That's led to worker shortages and supply chain issues. We now have significant foreign policy issues. The media is very focused on Ukraine, understandably so. I've spoken with a few of you that I think, while it's not talked about as much, it was several months ago. I think China still remains an issue on some people's minds. Will they continue to perhaps show aggression towards Taiwan, particularly once the Olympics end, which is what a lot of people speculate may happen. Corporate earnings reports, some have looked very, very strong. Some have not come in as well as expected. You have sectors that have been negatively impacted by what looks like either dramatically scaled down federal legislation, the BBB legislation, or perhaps none at all. You do have some retail investors who are really used to stocks only going up, kind of the Robin Hood effect, and folks who never have really lived through a down market. And then lastly, I think you have some assets that are not performing as well as has been expected. For just one example, not anything we're invested in, but for example, Bitcoin, was talked about as kind of the new gold or an inflation hedge. It has not behaved that way. We've seen it lose 45% of its value rather rapidly. So I know that was a lot. There's a lot of kind of conflicting signals and data points. We're not recommending any changes to the asset allocation at present. We, the staff and Marquette have, confidence in the board's work and judgment in how they've set up this portfolio for long-term success. And I'll turn it over to Kwaku, Dave, or Jesus if they want to make any other comments. And of course, we're happy to take questions.
Thanks, Chris. No, we would echo what you just mentioned with respect to the portfolio. The big thing is, our role as a long-term investor, being in a position where we can, unfortunately, do nothing during these nauseating rides with the market, with the understanding that some of these shorter-term dislocations are truly that shorter-term dislocations. And as longer-term investors, as we saw in 2021, as we saw in 2020, and as we've seen in other markets, just because the market's going down, it doesn't mean that all is lost and we need to change strategy or change course. Our asset allocation, it's very low on fixed income. That's a deliberate decision. It's higher on the private equity and the real asset side of things. That's also a deliberate decision. So some of the noise and some of the volatility that we're seeing from the traditional markets are being diversified away from some of these exposures within the portfolio. We obviously do have a healthy exposure to equities within the portfolio, but we have also made strides in recent periods to address ways in which we can bring volatility down within the equity portfolio. I know that right now Paperwork is being finalized on the low volatility side of things. Low vol is a really good example of a strategy or a way of investing that dampens some of the equity market volatility within a portfolio. Presently, and staff does receive daily updates from Marquette with respect to how the market's doing. We truly see this with the low vol numbers in comparison to the other major indices out there. So all being said, really just echoing Chris's comments that the fads, the Bitcoins, and some of the other things that sound really, really exciting and exotic, we continue to stay away from those. They're good to learn about academically. They're good to talk about over dinner, over a cocktail. But ultimately, our portfolio is comprised of your building blocks, the old school building blocks, the stocks, the bonds, the private equity, the real assets, and so on. And we do anticipate those segments of the portfolio, specifically real assets, private equity, private credit, to be a significant contributor to our returns over this volatile period in the equity markets, as well as over the long term. With that, Dave, anything
Quick,
to add?
just one before
Yes.
you go to Dave. You said that low vol has been performing the way it's supposed to over the last month. Can you put some details behind that?
Yeah, absolutely, Rob.
Great,
I'd
thanks.
be happy to do that. And that comment really takes into account some of the normalization of returns we've seen in the market. So what do I mean by that? Basically, in 2000, during the sell-off, the COVID sell-off, something really strange happened in the markets, right? When there's typically a sell-off, you'll see investors retreat to what's more conservative, what's attractively priced, what has good cash flows, what has good fundamentals, and so on. What we saw in 2000 was the complete opposite. Peloton, some of the stocks that, you question whether they should be valued where they're valued. These were the most attractive stocks, and growthier names, stay-at-home names, tech names really, really did well during the market correction, which again, you typically don't see during a market correction. During a market correction, you expect folks to really, really hug the conservative nature of a certain stock and the fact that it's got cash flows, the fact that it's got a discernible business model, but we didn't see that. We saw the Teslas and other names rally while other really good staple companies did not hold up as well. Now what we've... Yes.
Sorry,
Yes.
it's did you say 2000? You meant 2020, I guess, right?
Yes, I meant 2020. So
Yes.
not the tech sell-off. Sorry, it's my COVID brain. So I meant 2020. I'm not talking about the tech sell-off. I'm talking about the COVID sell-off. So thanks for that, Jim. But in 2020, in fact, Jim, though, in 2000, we did see value stocks rally tremendously.
You
and
got the
growth stocks didn't.
2000 in. Okay, good.
Yes, so I will drop 2000 in just.
Quaker was saying, thanks for reminding me, Jim. I should have talked about 2020.
Leave it to the clients.
2000, Quaker. I think we need to figure this out, man.
So basically 2000 is an example of the market sells off, value stocks do really well, quality stocks do really well. 2020, there was a sell-off. We did not see those types of stocks do well. We saw growthier names hold up well. What we are presently seeing in this market volatility today is those quality names holding up well. Apple, as an example, between March of 2020 and the most recent sell-off had tripled in market valuation. That is really just emblematic of some of the tremendous growth that we saw from the growth segment of the market. What we are now seeing again is just more of a return to basics and a return of understanding and appreciating what a good stock is. And if you compare the MSCI ACWI Min Vol Index as an example, again, the goal of Min Vol is to be down less than the broader market. So month to date, that Min Vol Index is down 3.28%. We compare that to the Russell 3000, that's down 9.43%. We compare that to the EFI index, which is down 4.32%. That gives us the sign and the indication that stocks that do have value, stocks that are quality, stocks that are comprised of companies with good cash flows and so on, these stocks are beginning to get respected again in the marketplace. So what we saw in 2020 was an anomaly with the growth stocks doing well during a sell-off. And what we saw in 2000, just to save face, is more typical to what we see when the market does pull back and when there's volatility. Quality type stocks will hold up well. So that's really what we're seeing from the min vol component of the market presently. And again, as a addition to our portfolio, the goal here is to dampen some of the overall volatility we see from the broader markets and take some of the equity market beta off the table. So that's what we are seeing from Minvol presently.
Thank you, if I may. U.S. indices in particular have experienced a huge growth in the technology sector. IT, or information technology, now represents around 25 to 26% of all U.S. equities. Technologies, or technology stocks in particular, are very sensitive to changes in interest rates. When we see interest rates increase or the weighted average cost of capital increase, and we discount a consistent level of cash flows, the net present value comes down. So that's why we have seen the biggest sell-off in tech-heavy indices like NASDAQ, like Russell 2000 growth. By contrast, non-US equity indices, and more specifically the ACWI Min Vol indices, has a lower exposure to technology stocks. So while we still see some sell-off of those names, the amount allocated to technology and interest rate sensitive sectors is far less than what we have in most US equity indices.
And in line with what Dave just mentioned, as we continue to see the market rotate, as we continue to see what the new normal looks like, we are seeing I guess more pressure on companies to produce, right? It's not just a headline, it's not just a tweet. Ultimately, seeing what the goods are will determine which stocks are holding up pretty well. And to Dave's point, interest rates are poised to go up. Interest rates, as we know, lead to a lot of sensitivity, particularly on the fixed income side. But with growth stocks, because growth stocks, the growth component is the biggest component of the return. Dividends are a smaller component of the returns. Growth stocks are going to be more sensitive. The quality stocks, those that have a dividend component, those that have more stability in cash flows and so on, they should be priced more attractively by the market. They should be in more demand. And by default, this environment is shaping up to be a pretty nice one for the quality, the min vol types of investments within a portfolio.
Kwaku, you mentioned interest rates, and of course, in the United States and in UK and in developed European countries, you're seeing a move to raise interest rates. China, we're seeing the opposite, right? We're seeing China as actually reducing their interest rates, or said they're going to reduce the interest rates. What do you make of that? What's going on there?
Yeah, I think it's a lot of things can be boiled down to mean reversion in our industry. And in the case of China, China has performed, there's been disappointing performance from China, but China has still seen, relative to other parts of the world, exceptionally strong performance. With that being said, China has seen a slowdown in economic activity relative to recent years. Really, in response to that slowdown, that's where we're seeing China move in a different direction from other economies within the globe. That's my official view of things. I would say when it comes to China and economic policy, and I'll choose my words carefully so it's not controversial, but I would say that the credibility of policymakers, the credibility of staying the course and so on, I do question that a little bit more from China versus like other economies. So I would say presently China is moving in a different direction from other major economies, and that's really because they've taken it on the chin a little bit harder than they had anticipated and the market had anticipated. And frankly, the sell-off that we've seen in emerging markets is really down to, again, China's prospects not being as favorable as they were this time last year. Some economies did, ultimately raise interest rates a little bit too quickly in the latter part of 2020, going on to 2021. Brazil was one of the economies. China is also muddled around with their interest rate policy. So presently, the need to push interest rates down is really just to buoy up their economy and buoy up their prospects. The U.S., on the other hand, is facing significant inflationary pressures. Other economies are facing higher inflationary pressures to a degree where interest rates do have to go up. China is presently not there, and that's why they are moving in a different direction from us.
Yeah, and I would also, just like Chris commented on your report, and the reports are good on a monthly basis. And however, when the market's going straight up, you look at the report, say, yeah, thanks, that's a nice report. But now with the volatility, a lot of the information in here is very timely. But I wanted to get your view, or Dave's view, on the GDP return came out and it exceeded expectations. I think it exceeded expectations by about a percentage point. Is that a surprise, or what does that tell us about the resiliency of the U.S. economy?
Yeah, absolutely. Dave, do you want to tag team this one? I can't see you, so.
Sure. Yeah, I'll offer a couple of thoughts. And I think that from that print, and that's the largest year-over-year GD print since I think 1984. And obviously a lot of that's backward looking. It relies on what's happened, not what's in store. The reality is wage inputs are much, much higher. Energy inputs are much, much higher. And then there is an outlook for slowing growth as is Omicron still, or COVID still has an implication. So companies are going to be hit from both ends, top line growth and then higher input costs. So while we did see a very rosy GDP print, the expectation, and I do think we have a slide in here, we at least do in our broader market environment, is that GDP expectations will normalize over the next 3 to 4 years. Great print, great reflection of expansionary activity following a release of pent-up demand, but that will normalize due to wage pressures, inflationary pressures, and higher energy costs.
Okay, thanks, Dave.
And really, just to close the loop on that, I would say that the one good analogy here might be that of the weightlifter. They take a Red Bull before they go to the gym. They have the best workout, but then the vitals drop and they go back to their normal rate of working out. And I would say that the Red Bull for us was the trillions of dollars spent. In addition to the trillions of dollars spent, the supply chain disruptions, and then also just the seismic movement we've seen in the labor market has led to some well overdue wage growth. All of this has pushed things upwards, but as Dave noted, these things will essentially normalize unless, and this is a big unless there's more money spent, unless there's more stimulus, unless something equally unprecedented happens where the government has to intervene. We do anticipate things to begin to normalize. Less government intervention will mean less in the way of higher inflation numbers as we've seen, and less in the way of stronger GDP numbers as we've seen, and more around that 2-3% range, which we're more accustomed to, as opposed to, again, the very high single-digit bounce backs in GDP we've been seeing of recent.
And Kwaku, because this is partly tongue in cheek, but because Chris values your opinion so much, can you please advise him to read poetry or meditate before he goes to bed instead of looking at the futures every night?
Yes, absolutely.
Thank you.
We'll send him some coloring books.
Yeah, great. Thank you.
Anything else, Chris, on the report? Any other questions from members of the board? Okay, so let's move to the staff report.
Sure. The securities lending income, began to rebound as a result of the transition over to Northern Trust from JPM for custodial banking. So you see around $63,000 in income for the month, 916,000 for the year, and close to 50.4 million since inception. In terms of diversity and local AUM, raw dollar amounts for diverse and local managers didn't change very much. In fact, in the case of diverse managers, actually went up around 25 million. But because the portfolio as a whole grew 3.2%, you see that on a percentage basis ticked down in all categories. So 26.3 combined, 19.5 for diverse only. And for Philadelphia and surrounding counties, just under 9.2%. Lastly, we have the upcoming board meetings, which I think Fran and Anu mentioned. The next two will feature additional actuarial presentations. So we have February 24th, March 24th, and April 28th. And that concludes investment staff's report, absent questions or additional items.
Any questions from members of the board? Okay, is there any new business? Any old business? It's been moved and properly seconded that the investment committee adjourn, and we are adjourned to call the full board into session. It has been moved and properly seconded that the actions taken in the investment committee be ratified by the board. I'm sorry to do this to you again, Jackie. Can you call the roll?
Sure. Diana?
Approve.
Brian?
Administration one.
I approve.
Vanessa?
Approve.
Marcia?
Approve.
Roosevelt?
Approve.
Paul?
Paul, you're muted.
Approve.
Thank you. Carroll?
Approve.
And Kellen?
Approve.
Okay. Is there any new business? Any old business? Then it's been moved, probably seconded that we adjourn, and we are adjourned. Thank you all very much.
Thank you.
Thank
Thanks,
you.
everybody.
Good day.
Thank you.
Have a
Bye,
good
everybody.
day.
All right, take care,
Good
everyone.
weekend. Thanks,
Take
everyone.
care.
Thanks, everyone.
Carol.
Carol, congratulations, Carol.
Yes, congrats, Carol.